Are you worried how your country's central bank's rate hike might affect home loan interest, affecting how much you pay monthly for your mortgage? The US Fed has just raised the rates once more, this time by 50 basis points during its last meeting. And be sure this decision is going to affect your home loan interest, if you are living in the United States, of course. Meanwhile, in China, home loan rates are falling to record lows as angry home buyers across the country have threatened to stop paying their mortgages on unfinished homes. They are crashing the markets, which prompts businesses and authorities to take action to calm the storm. Exactly the opposite is happening in the US, as mortgage rates there go crazy this year, with the average interest rate for a 30-year fixed-rate mortgage jumping from around 3.5% in January to 7% in October. See, people planning on buying property and those already paying off their mortgage should keep a close eye on central bank's decision to understand how they might affect the amount of money one pays for a home loan. We need to get one thing clear: central banks do not set mortgage rates. However, their actions indirectly affect mortgage rates. For example, during one of the previous US Fed meetings, which was held in November, they raised the target federal funds rate by 0.75%. And in response to this year's central interest rate hikes, mortgage rates have risen almost as much, with some analysts predicting that they're likely to increase further in America and Europe, as Europe raised their central interest rates as well. While this is not the first time the mortgage interest has been that high in countries like US, it's been a long time. Many factors influence home loan rates, including inflation, interest rates, treasuries yields, unemployment, and whether the economy is growing or shrinking. And any country's central bank has two primary jobs. One is to encourage job growth, and the second one to keep inflation under control at the same time. To keep unemployment and inflation low, central banks create monetary policies. Policies help them manage the supply of money and the cost of credit. Their primary monetary policy tool is the federal funds rate, which is the interest rate that governs how much banks pay each other in interest to borrow cash from their reserves kept at the central banks. Thus, they can decide to hike or cut interest rates based on the economic data presented to them. Although in finance, there's nothing called federal mortgage rates. However, the federal funds rate influences interest rates for long-term loans, which include mortgages. The central banks also influence mortgage rates when they buy or sell debt securities in the marketplace. For example, the mortgage rates in the US dance alongside 10-year Treasury yields. In other words, the mortgage rate goes up when Treasury yields go up. To put it as simply as possible, the best time to get a fixed-rate home loan is when Treasury yields are low. It means that generally, the mortgage rates are indirectly influenced by the rate of the loans most governments or banks issue to their citizens and other banks. Take in the United States as an example. The 10-year Treasury bonds are loans issued by the government and take a decade to mature. Every financial tutor will tell you that the Treasury bond is one of the most secure investments offering low risks. This is because the government issued the bonds, and the government will most likely not default. The government pays yield on the Treasury notes sold to the public. During high inflation, the Feds incentivize investors with a higher yield. Since the Feds issued the bond, the Feds can take actions that might move the rate on 10-year Treasury bonds higher or lower. For example, in 2020, during the pandemic, there was a severe disruption in the Treasury market, making borrowing money more expensive than the Fed wanted it to be. In response, the Federal Reserve announced it would buy billions of dollars in treasuries and mortgage-backed securities. The move supported the flow of credit, which helped push mortgage rates to record lows. So how exactly does the interest hike or cut affect how much you pay for mortgage every month? Central bank rates affect short-term loans such as credit card debt and adjustable rate mortgages, but do not affect the fixed-rate mortgages. However, if you have an adjustable rate mortgage, it has a floating interest rate that goes up and down with the market every month. In this case, it would be best if you kept a close eye on the Fed and the mortgage market's attempts to interpret the Fed's decision to affect how much you pay for your home loan. It's in your own interest after all. If you're struggling to make your mortgage payments, you may be able to refinance your mortgage. Refinancing means taking out a new loan to pay off your existing mortgage, and it can help you get a lower interest rate or more favorable terms. This can make your monthly mortgage payments more affordable and help you avoid defaulting on your loan. To refinance your mortgage, you will need to apply for a new loan and go through the same process you did when you first bought your home. It's important to remember that defaulting on your mortgage or refinancing your loan can have serious consequences, so it's always a good idea to talk to a financial advisor or a housing counselor before making any decisions. And though high mortgage rates may not directly affect you as a homeowner, increased mortgage rates may reduce the pool of potential purchasers in your neighborhood. So if you're attempting to sell your house, higher rates means buyers can only afford to buy smaller homes. Suppose you're shopping for a new home while waiting for high mortgage rates to drop when there are rumors of a future recession. In that case, trying to time the market is dangerous by waiting for lower mortgage rates or house prices, because banks might not be that forthcoming when rates drop. So you might not even get a deal.
There is some good news on the horizon though. We expect inflation to start falling towards the end of the year and continue through into 2023, which will probably mean that interest rates will fall as well. We think that by the end of next year, it's possible that mortgage rates in the US will have fallen to 5% or possibly even lower.
Let's finish having one important thought in mind. Regardless of the state of the economy, being able to afford your monthly payments comfortably is the most crucial factor to consider while searching for a mortgage. Thank you for watching another episode of On Finance. My name's Ray. Goodbye.